Is inflation here to stay, or is it transitory? I think the answer is going to shock you. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the policies that fueled the inflationary powder keg. In 2020, we had government-issued lockdowns in the United States and globally, where they wouldn't let you go out of your house, but also they wouldn't let you spend money. Or very few people were spending money the way they traditionally did. We're going to get to this in a moment as far as ordering more products online. Also, we all know about these stimmy checks. The government, you're drunk, insolvent. Uncle Sam started sending everyone in the mail these checks, but not just stimmies, increased unemployment benefits, also tax credits, and they lowered the average Joe and Jane's expenses by saying, hey, listen, you can't evict any tenant. We had this eviction moratorium, and then we had a mortgage forbearance. So I'm not saying everyone took advantage of it, but it was there for people who needed more assistance or wanted to take advantage of more assistance to increase their purchasing power. So no cost of housing for a good portion of the United States. Keep in mind those same people that are getting the stimmy checks and additional unemployment benefits. So now let's dive into the details a little bit deeper. We have corporation or business XYZ. What did they do back in March and April of 2020? The first thing, they thought we were going to have a deflationary bust, that everyone would stop spending, something similar to what we saw either during the Great Depression or more recently during the GFC 2008-2009. Editor, go ahead and throw up a chart where we did see slight deflation of consumer prices, and we definitely saw deflation in asset prices with the housing market and the stock market. So they're expecting something similar. So they started laying off a lot of their employees, which means they started to produce less stuff. Their inventories drew down because there was consistent demand. Because of those stimmy checks, incomes actually went up. So at a lot of stores, although they expected their sales to go down, they actually increased. But the inventories, not only for the retailers, but the suppliers in the global supply chains was reduced dramatically. Okay, so what did the individuals do, the consumers and the employees of the businesses? Well, they started to hoard things like toilet paper. We all saw that. So the businesses lowering their inventories, but the customers, the average Joes and Janes, they were hoarding materials. They started saving money, and this is the key. This is what nobody is really talking about right now when they're trying to think through this question, is they changed their behavioral patterns, the way they buy, where they live, and therefore the products that the retailers and the suppliers need to keep in inventory. More on that in just a moment. And then the government, of course, they increased incomes with these stimmy checks, unemployment, tax credits, and then reducing people's expenses. They increased their incomes or disposable incomes dramatically. Just in March of 2021, incomes increased by over 20%. And we saw the exact same thing when you compare Q2 of 2020 to Q1. As we said, they decreased the expenses. Savings went up. And since they were locked in their houses, we had a lot of pent-up demand. Now, I'm not someone that says that this is going to create an inflationary boom forever as far as this pent-up demand. But to some degree, it gives some tailwind to inflation. It is true, these individuals aren't going to go out and buy 25 steak dinners for all of the dinners they missed in 2020, but they're going to go out and do some spending when they're let out of their cage. I think it's only natural. And because their purchasing power has increased significantly due to the factors we were talking about earlier. So let's think through what this does with the dynamics of supply and demand. We start off with the demand being pretty close to the supply. We're at an equilibrium point. We lived in this global economy that was just in time. So it was very efficient, but they didn't keep a lot of inventory. But we start to see a huge imbalance due to a couple different reasons. First, demand goes up, let's say because incomes increase, but the supply of stuff goes down because the producers aren't producing as much as they were due to the fact that they laid off a lot of workers and they think we're going to have a deflationary collapse. But another reason goes back to this key that we were talking about before: change in human and consumer behavior. So the average business may have seen an increase in demand, not just due to an increase in incomes, but also because people were buying different stuff. And they made that switch, that change so quickly, it catches them off guard, so they don't have the capacity to fill the existing demand. So even if the supply of what they were making in 2019 stays the same, we could see a huge imbalance. Let me give you an example of exactly what I'm referring to. Editor, let's go right to the internet. Okay, this article is from Bloomberg. For London-based packaging company DS Smith, challenges are coming from multiple sides. During the pandemic, customers rushed to online purchases, raising demand for its e-pack boxes and other shipping materials by 700%. See, it's not just the consumers shifting their behavior, but them doing it overnight that puts tremendous strain on other types of supply chains that most of us would never even think about, such as the boxes used to ship things that people buy on Amazon. Then came the doubling of its supply costs to 200 euros a ton for recycled fiber it uses to make products. It's a significant cost for a company that buys 4 to 5 million tons of used fiber annually, said Miles Roberts, DS Smith's group chief executive, who doesn't see the lockdown inspiring web purchases as a temporary trend. He says the e-commerce that has increased is here to stay. This is just one example of the changes in consumer behavior affecting the supply-demand imbalance. So what that story highlights is just how fragile and nuanced these supply chains are. And this was just an example of an e-box. So basically what happens is Moody right here, oh, I forgot to write Moody's name up there. Oh no, but you guys can tell who it is because of their blue hair. But Moody usually would buy at Target with their money they were making from Starbucks and Uber. But now they've got a lot more money because of the stimmy checks from your drunk insolvent Uncle Sam. But they don't want to go to Target because they don't want to have to wear a mask, or they're scared of the cerveza sickness, whatever it is. So they start to buy things directly on Amazon. So this shift, and it didn't happen gradually, it happens overnight because of what we saw, the dramatic, unprecedented changes we saw in 2020. So it catches all of these suppliers off guard. Where the guy who is creating these e-boxes, let's say for the Amazon deliveries, they're making this much, but overnight they get orders for this much. Plus, all your employees are locked in their house. What do? You have to increase capacity, but to do so, it's not like a light switch. You not only need additional factories, but you need additional equipment to produce the stuff, in this case, those e-boxes. So what happens to demand goes up because of a shift in consumer behavior, but supply cannot keep pace. Another example that I'd like to use is just the migration that we've all heard about from people moving from the city, maybe into the suburbs. And that's the best job of drawing a house I could actually do. Or over here, out into a rural area where the guy's got a barn, maybe some silo, and some cows, but they're really going out into the sticks. But this movement, this transfer of people from the urban areas to suburban or rural areas, we talk about it in the terms of real estate, but we don't really think through the dynamics of what happens to consumer behavior. The people who lived in the urban areas before, now, if they're in suburbia or on a farm somewhere, they're buying different types of items. You're not buying any 2x4s if you live here. If you live here, maybe you are. You're not buying any hay. Maybe you're buying copper. Maybe you're buying, who knows what you use on a farm, some sort of tractor, which you wouldn't be buying over here. You see? But the transition happens so quickly. That's what I really want to emphasize. Normally, if it gradually happened in a free market where consumers just make different decisions, the businesses would be able to expand at the same rate. But because this happens overnight, they're all caught behind. So demand goes up, supply goes down. This is the dynamics behind what happened. Now, let's get into what is happening right now and the degree to which it is happening so we can connect the dots and answer the question, figure out the probabilities of inflation being temporary or permanent. Step number 2. Now let's talk about the current pressure on prices that are exacerbating the problem we discussed in step number 1. The policy powder keg from the government where they're instituting lockdowns, giving out the stimmy checks, and reducing most people's overall expense or their main expense, which is housing. This created huge imbalances in the supply and demand, not just because of the stimmy checks, but also because of behavioral patterns shifting with the consumer. But let's take it to the next step. Where are we today? The government has continued with their unprecedented stimulus, whether that's in the form of these new infrastructure bills or the billions of dollars they have wasted just handing money to their buddies through the Cantillon effect, or the money that's gone to the individual consumer. But they have done at least 3 or 4 rounds of these stimulus packages, and I'm assuming they'll do more. More on that in just a moment. The consumer has gone from hoarding and staying in their house. Now that things are opening back up, we see unprecedented levels of spending. And the businesses, the retailers, have started hoarding inventory. They're doing the opposite of what they did at the beginning of the cerveza sickness. They're buying 3 times, 4 times the amount they typically would at almost any price. And then that flows down to the manufacturers themselves that are creating the goods that are going to the retailers, and it trickles down to the actual producers themselves. You see how it starts with your drunk, insolvent Uncle Sam spending the funny money into the economy. Those consumers send that money to the retailer, it goes down to the manufacturer, over to the producer. But the producer, because of all the distortions that were created in 2020, they can't catch up with the demand from the manufacturers. As a result, we get massive shortages and higher prices. To understand the degree to which this is happening, let's go right back to the internet. Let's go back to this Bloomberg article entitled, "The World Economy is Suddenly Running Low on Everything." And when you read the entire article from start to finish, you see that they're not exaggerating at all. Really staggering what's going on right now. As an example, Mattress producers to car manufacturers to aluminum foil makers are buying more material than they need to survive the breakneck speed at which demand for goods is recovering and assuage, which is probably the most ridiculous word I've ever heard. Why use a word that nobody knows? I had to look that one up. It means some sort of fear or something like that. Regardless, that primal fear of running out. The frenzy is pushing supply chains to the brink of seizing up. Shortages, transportation bottlenecks, and price spikes are nearing the highest levels in recent memory, raising concern that a supercharged global economy will stoke inflation. And I like to replace the words supercharged global economy with a more accurate description, because this implies that the economy is doing really well. But the more accurate description would be supercharged money printing. And there's a big difference between economic growth and money printing. And Bloomberg isn't doing a good job differentiating between the two. But that's why you watch the George Gammon channel. I'll do it for you. Copper, iron ore and steel, corn, coffee, wheat and soybeans, lumber, semiconductors, plastic, and cardboard for packaging. The world is seemingly low on all of it. You name it, and we have a shortage of it, said Tom Linebarger, chairman and chief executive of engine and generator manufacturer Cummins. This illustrates perfectly the simple example I just went over on the whiteboard. So hopefully you're starting to understand some of the problems we have on the supply side of the equation. But let's dive into the nitty-gritty of the demand side. We talk about incomes going up, but how much? It's very important we really understand the details. To find the data, I went straight to the website of the Bureau of Economic Analysis. And these numbers, when you look at them at first glance, are a little confusing, but don't worry, I'll walk you through them. So first, let's focus on personal income, this top line number. February 2021, around 20 trillion. March goes up north of 24 trillion. Now that may have just made your head explode, but it didn't actually go up by 4 trillion. These numbers are annual rates. So what they do is they use them month by month, but you've got to divide by 12 and get the actual number to compare that to the month prior to see the delta. And I know it gets a little confusing. Why do they do this? It's so you can compare the monthly statistics with the quarterly statistics, which are done through annual rates as well. So understanding that, let's go through the rest of the numbers to see where the biggest change took place. And for the sake of time, we'll just scroll right down and I'll point it out. It's economic impact payments. That went from an annual rate of 95 billion to an annual rate of over $4 trillion in just 1 month. And I know that sounds like a huge number, but again, you got to divide by 12 and you get right around, I think, 300 billion, something like that. But think about how much of an increase that is in purchasing power across all the United States in just 1 month. So when we talk about incomes going up, we're not talking about just a little bit here and there on the margin. We're talking about huge increases that we have never seen before. And it's a direct result of the government creating more of those currency units, dollars, and injecting them directly into the economy. So I know a lot of you right now are probably saying to yourself, okay, George, I get it. We went over the policy powder keg in step number 1. Here in step number 2, I can understand how the problem is getting much worse. But we still don't know if the problem is going to continue into the future. Is the inflation that all of us have seen with our own eyes and probably with our wallets, Is this going to be permanent or is it going to be temporary? Let's go ahead and connect the dots right now. Step number 3. Now let's go ahead and put all the pieces of the puzzle together to determine the probabilities of the inflation we're seeing right now being temporary or something more permanent. And I really thought through how to illustrate the point I was trying to convey with this step. Here's what I came up with. A healthy economy, the way things used to work, was the whole entire system revolved around the real economy, producing goods and services efficiently. So for a moment, I want you to imagine the real economy as a hot air balloon. And the basket that is being held up by this hot air balloon is the financial economy. And the banks are lending money into the real economy to further productivity and growth. The government is selling debt into the real economy. Those entities and individuals are buying the treasuries. Then the government is recirculating the money that's coming out of the real economy, putting it back in and spending it for infrastructure, welfare, what have you. And the Fed is way off in the corner, really not doing a thing. Nobody's paying attention to them. In fact, most people in the real economy don't even know what the Fed does, nor do they know who the Fed chair is. And they don't really care because they're too busy producing stuff. So my main point is the wealth and the standard of living of society as a whole is based on the real economy going up or going down. But now we have a much, much different system. The hot air balloon is no longer the real economy. It's the financial economy. And the basket is now the real economy itself. It's shrunk down to a point where if the financial economy goes up or down, so goes the real economy. They've completely flipped. And now what happens is the government is much, much bigger. Instead of selling those treasuries into the real economy and recirculating the money, the government can now only sell the treasuries to the Fed that has to monetize the debt by creating more funny money, fugazis, bank reserves. Therefore, the money, currency dollars, the government spends back into the economy increases the money supply, where over here, it's pretty much a net wash. Also, the commercial banks are no longer lending into the real economy to facilitate that productivity growth. They're just lending directly to the financial institutions and hedge funds to blow up the bubble we're seeing in the financial economy with pretty much every single asset class. The real economy is no longer producing the stuff that it produced over here. In fact, in this economy, we are producing so much stuff, producing more than we consume, we could actually export the excess stuff to other countries. But over here, we're not really producing anything because the system has deteriorated and moved into this financial economy behemoth. So we have to get our stuff from country XYZ. And the only thing we're producing here are just domestic services that circulate within the domestic economy. And then what we're doing is we're taking some of the newly created money from the government and just putting that back in to the financial economy to blow up the bubble even further. Because now that's the only way for the average Joe and Jane to get ahead, is to take their money and speculate in the stock market. Now let me recap briefly just to make sure we're on the same page. In this healthy economy, what we had in the past, the wealth or the standard of living with society was predicated on the real economy going up or down, how well the real economy was doing. Now, it's pretty much exclusively based on how well the financial economy is doing. The problem with this is in order to sustain this type of system, the bubbles need to continually increase in size. Therefore, there needs to be more and more funny money created by the Fed and the government that's pumped into the system. Now let's go back to step number 2. Remember the diagram we put up here, that circular motion that ended with the producers. The producers have to deal with scarcity. The government and the Fed don't have to deal with scarcity because they can create an unlimited amount of currency units, dollars, and inject them into the system. But now let's remember that the funny money being injected into the system is a monetary heroin, like my good buddy Peter Schiff always says. So we go down to this diagram. We got everyone's favorite heroin guy from the streets of San Francisco. But what I wanted to point out is that in order for heroin guy to get the same effect or the same type of high, he needs to take an increasing amount of heroin. And it's the exact same thing with the government, the Fed, and the financial economy. That financial economy is like heroin guy. It needs an ever-increasing amount of the monetary heroin. And if it doesn't get it, it comes crashing down. And because we have this perverse, distorted system, if the financial economy comes crashing down, so does the real economy. So what does this have to do with inflation being transitory or something that's more permanent, like we saw in the 1970s? It boils down to the system and how many of those dollars the government is going to have to continually create, and how much it will have to increase the rate at which it's supplying the financial economy with those dollars. We saw an example of this in 2020. Editor, go ahead and throw up the chart of M2 money supply increasing by over 20% in 1 year alone. That's a good example of this process we're talking about. So since those producers that really feed the entire system, and if the producers aren't producing enough, then we're going to see shortages and we're going to see higher prices. But again, they're constrained by scarcity. You can't just flip a switch and get more copper. It takes years to develop those copper mines, to use that as an example. So the question really becomes, will the core producers be able to keep pace with the money printing of the government and the Fed? And I believe the probability is very, very high that those producers will not be able to keep pace with the money printing. The money printing will have to continue exponentially, just like we saw QE. We had QE1, that was supposed to be it. But what happens? We get QE2, we get QE3, we get QE infinity. I think it's going to be the exact same with stimulus. Therefore, the amount of dollars that are being created and pumped into the system. I think this is going to happen at a much faster rate. The producers are not going to be able to keep pace. Therefore, the probability is high that this inflation will last into the future. And when I say that, I'm talking about 3 years, 5 years down the road. And I want to be very clear. I'm talking about consumer prices. I am not talking about asset prices, nor am I talking about the dollar on the DXY against a basket of currencies. Just talking about consumer prices. Oh, but wait, there is more. Got a bit of a surprise for you. If we take this idea to its logical conclusion, it takes us to central bank digital currencies. And I know this is a topic for a completely separate video, but I wanted to plant this seed. In order for the central planners to get more of these dollars into the system, they're going to have to get around the commercial banks. And I think they'll do that eventually with the Fed setting up FedCoin, or their own central bank digital currency. But I'll let you determine the probabilities, and we'll definitely save that for a future video. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.